enable.
Hello and welcome to Season 5 of NSE FinWiz powered by CNBC TV 18, and I'm your host Nitya Balakrishnan. Today we're in India's Garden City in the campuses of one of the world's leading IT consultants, Mindtree in Bengaluru.
Since 1999, Mindtree has been delivering IT solutions to global clients. Today, the company offers digital transformation and technology services to around 2,000 companies in an agile, collaborative approach, customizing solutions across the digital value chain. Its deep expertise in infrastructure and applications management creates strategic assets which helps run businesses efficiently. NSE FinWiz, with its theme Dream On, engaged with the techies at Mindtree Bengaluru to understand their aspirations and help them fulfill their financial dreams.
We think this is a great initiative going to corporates, using the medium to reach out to young talent at the beginning of their professional career. So if these lessons are taught to them at an early stage, hopefully they'll plan accordingly and be successful later on in their lives.
I dream of having a safety net that I can fall back on irrespective of whatever kind of investment I do make or whatever entrepreneurial plans that I have out of Mindtree. My dream is to have like a safety net where nothing really pinches my pockets, even if it's a big risk that I'm taking.
I dream of having a different apartment or a house of my own where I am seeing myself in a well settled long the term.
My dream is to visit multiple foreign destinations, enjoy my milestones in life, and lead a luxury life.
A luxurious house, of course, and secondly, a 5-star restaurant. That is what I dream for myself.
Hello and welcome to Season 5 of NSE FinWiz powered by CNBC TV 18, and I'm your host Nitya Balakrishnan. Today we're in Mindtree's campus in Bengaluru, and joining me on the show is Harshavardhan Rungta. Thanks so much for joining us, Harsh. My first question to you as we start the show is, we know about making money, saving money, but how many of us really work towards multiplying money, and why is that so important?
So Nitya, if you look at a concept of generating or creating wealth for yourself, it's important you do two things. One is, of course, you need to generate that income that is out of your productive employment. It could be business, profession, whatever. Now, once you start generating a source of income for yourself, it's important that you invest your money in such a format so that your money also generates an income for you. So you'll have a dual income in that sense. Now, a major misconception is that I do not have enough to start investing. Let me earn a little bit more, let me create a larger corpus, only then can I invest. Well, that is absolutely wrong, because you need to understand if you can actually create wealth with even a small amount starting early in your life. The moment your passive income, which is your investment income, is more than your active income, that is the time you can actually talk to yourself and say that, okay, I've done something good for myself in terms of monetary, in terms of wealth creation.
So for a lot of us and our viewers, what are the vehicles that you would be looking to park funds in today's day and age? Because all that we traditionally do is maybe fixed deposits, NPS, pension schemes. But what are the new age vehicles for you to park funds so that the funds also grow exponentially?
There are products which are designed to meet requirements which are even one day away. So you have a product which is going to address a need which is one day away and one which is even 40 years away. The question is, how do you create a portfolio? How do you pick what is relevant to you? So here is where you will need to set out certain goals for yourself. So there is a timeline that you will have to set aside. I mean, you'll have to be very clear about it. When you set a timeline, it helps your advisor to create a portfolio accordingly. Now, if you needed money in one day, in about 1 month from now, and an investment portfolio has been created keeping in mind 10 years, then there's a mismatch. Then of course, you're not going to get what you desire to get. So as an investor, what you need to do is first identify why are you saving this money.
So if I were to ask you 2 to 3 vehicles, according to you, the top 2 to 3 vehicles to park funds, what would they be in today's day?
Well, so in case you are saving your money for say our immediate requirement, which is less than 1 year. It could be buying a car, house, holiday, could be anything for that matter. Then you need to take everything which is non-equity. So it could be a recurring deposit if you want to save on a monthly basis. It could be a debt fund offered by a mutual fund, asset management company. It could be fixed deposits if you have a lump sum. So these are the kind of products you will look for investments only up to 1 year. Now if you have a requirement which is say probably 1 to 5 years, then you will try and mix and create a hybrid product, wherein some portion of your money, or rather major portion of your money, will be into debt. So you could have a 70% money going into fixed deposits, recurring deposits kind of thing. And you can take slightly more exposure into equities because you have a 5-year horizon.
Horizon, long term.
Yeah. When it is beyond 5 years, then of course you can take more risk. You can reverse the ratio. You can have 70% in equity and 30% in debt.
Fantastic. So if I were to ask, a lot of us, how many of us look at insurance as the first place to park funds for tax saving? Harsh, my first question to you, is this the right attitude?
If you're investing only to save tax, but that is your only objective, you will land up buying something which is very conveniently available to you. It means that you will not get into the product specifications, you will not try and match the product features to your needs. What you will only simply do is fill up the form, give me the proof as fast as possible so that I can give it to my accounts and they will not deduct tax for me. Well, that is a wrong thing to do. That's absolutely the wrong thing to do.
What are some of the other options we have to park your funds for tax exemption?
Well, when we look at it from the investment side, I mean, you would have, of course, insurance, which is one avenue where you can save tax. Then you have your provident funds. The employee provident fund gets deducted from your salary. That also qualifies for Section 80C deduction. Then there are certain bank deposits that you can make. There are national savings certificates. So these are the entire gamut. Then if you're looking at an equity, like suppose you're looking at long-term wealth creation for yourself, and we talk about equity being the best asset over long term. If you want to invest into an equity and also get tax benefits, then there are products available which are under the category equity linked savings schemes, the ELSS schemes.
If we are first time earners and you don't really have dependents, you don't have anybody in order to buy insurance, or you don't have any exemption under say children's education, etc. So then how do you use ELSS as an option or as a savings tool?
Choose a product which is equity mutual funds. Okay, you have two kinds of products there. One is that you invest, you can withdraw whenever you wish. That's an open-ended fund. You enter now, you withdraw anytime, whatever you want to do. But you won't get a tax benefit on that. What the government says, if you want any investment to give you tax benefits, I'm going to make sure that there is some lock-in for that investment. So while your PPF will be a 15-year lock-in with partial withdrawal allowed after a certain number of years, ELSS has a 3-year lock-in. So these conditions being fulfilled, you can choose an ELSS fund, which is again offered by an asset management company, a mutual fund, under the special category. So, and when you invest that money, it's going to get locked in for 3 years. So ideally, you analyze if your PF deduction is already 50,000 a year, for example, you need another 1 lakh to cover up for 1,50,000. So you have about 8,000 rupees to invest every month. From April itself, you commit an SIP of 8,000 rupees into an ELSS fund. You're taken care of for the entire year, which is 1,50,000 by March. And you're investing in a market through a systematic investment option, which is, your rupee cost averaging. So the markets are high or low, you're buying at every level. So it works as an investment tool. It works for your wealth creation objective of achieving your goals. At the same time, it also gives you tax benefits.
Well, on that note, it's time to slip into a quick break right here on NSE FinWiz. But stay tuned. The importance of goal setting for financial planning on the other side. Welcome back. We're still in conversation with Harshvardhan Rungta right here on NSE FinWiz in Mindtree, Bangalore. And Harsh, if I can ask you, when you look at losing weight, when you sign up for a gym, you think, okay, my target is going to be maybe 2 kilos in the next 6 months. Like that, how important is it to set a goal before you start working towards that as far as financial planning is concerned?
Which investment product you use or choose is dependent on how far you want to go. Now, for example, if you had to travel to Mumbai, for example, you will not start riding a cycle, right? Even if it's deemed safe. Correct? You will take an aeroplane because otherwise it will take you how long to reach your target. Similarly, if you have to save for retirement, which is 40 years or 30 years from now, and you're investing in a recurring deposit which is growing at a snail's pace, you're in a wrong vehicle. It's like riding a cycle to Mumbai. At the same time, if you want to go in the next lane, and you can't hire an aeroplane for that, right? You need to use a cycle or a small vehicle to go there, right? So you need to have an appropriate investment plan to match your goals. Unless you know what your goal is, how will you know which vehicle to take? So setting up your goals with a clear timeline is important in designing a portfolio of self. If you don't do that, then invariably you're going to be buying something which is not required by you.
Well, I'd also like to bring in Sri Krishna Varkhedi, who's 24 years of age, into this discussion now.
I want to retire rich without any debts or any dependencies, and my time horizon is 15 to 20 years, and corpus would be around 5 crores. So how do I achieve that?
If you're going to think long term, a small amount can help you achieve this target. So if you have a 30-year target, for example, in this calculation, all you need to do is invest 10,000 rupees a month, and you will achieve your target. Now this same 10,000 rupees, because it is for a longer period, you can choose equity as an asset class. And if you had not chosen equity as an asset class, fearing the equity markets, fearing the news that is around, and you choose to invest in a debt or a debt-oriented insurance policy, the corpus would be about 16 to 17 lakhs, as against a 54 lakhs. So which means if you have to achieve 54 lakhs, you have to invest how much more? So you have to make your money work very hard for you in an inappropriate asset class.
But there's also a very important tool called systematic withdrawal plans. And with respect to this, I'd like to bring KP Shreya into this conversation.
So my question is basically to have a recurring income post your retirement. And maybe, if you can even pass it on, I can pass it on to my family, something of that sort, with an average investment of about 30,000 per month, if I could say. Then how do I go about it?
It's very important that when you set your goals, it also has to be realistic. So one is a 10 crore with 40,000 rupees a month in 10 years cannot be accumulated. So that is the first thing. Secondly, when you reach retirement, or when after at one time you might not want to work beyond a point, right? So how do you get regular income? So one form is that you put that entire corpus in an interest bearing product. So which means there is an interest which is going to be paid out to you. You can even buy a property and earn rent over it if that is your option. Or the third option is that you can leave the investment as it is, because you do not treat the entire amount at one shot, right? So you can continue investing, continue to be invested as it is, and set up a systematic withdrawal plan. Upon retirement, you can choose an SWP, systematic withdrawal plan. So you can mandate the fund house a fixed amount of money that you need every month. They will redeem that much money and give it to you in your account. And the rest of the money continues to be invested as it is and generate the returns that it is invested in. If it's a debt product, it generates the debt returns. If it's equity, it continues to be in equity.
Is there a ratio of how much should go into something like a assured return scheme, like a life insurance scheme, which is assured return, versus the other ratio of what should go into a mutual fund kind of an investment or equity ELSS investment?
Because the sense of being assured is like one person says, you give me 100 rupees, I'll give you 105 assured. The other says you give me 100 rupees, but the possibility of getting 115 rupees is there. What would you want to take? It's a choice. The question is, being safe is always easy to do. But whether being safe is good enough, because you're looking at a return from an insurance policy which is going to be in the range of not more than 5%. If that is what your sense of assurance is, then you haven't looked at inflation yet. On the other hand, you have to understand that if 20 years is your time horizon, because an insurance policy ideally have a 10-year plus tenure, right? If you can stay invested for 10 years and above, and if you invest every month in an equity market through an SIP in a basket of stocks, okay, there is a past data, historical data. If you have made an SIP investment for the last 10 years, okay, the worst performing scheme, there could be about 500 equity schemes operating in the market, and suppose you picked up the worst scheme, okay, that was available. So you were very unlucky, you picked up the worst scheme. The average return of that worst scheme over a 10-year period is about 8%, which is still better than the best fixed deposit would give you.
So if I can have Harsh answer a question of Dr. Ashwini Suri, who says, in times of political uncertainty, rising inflation, possibility of war, and low, FD rates, how effective can equity investment be in such scenarios?
Equity is risky. So that is what we are trying to understand, that there are several external factors which affect the performance of a market. Well, that is how equity markets are supposed to be. The idea is I participate as a systematic investment plan. I had, say, about 1 lakh of rupees to invest in a year. What I will do is I will not put the entire 1 lakh at one shot today, because the markets could fall tomorrow. Right? If it goes up, I'm happy, but I don't know which side it will go. What I would do is I would put 8,000 rupees in this month. So I buy at about 36,000 levels. Next month, again, if the markets have gone down to say 34,000, I have put another 8,000 rupees. So I've averaged my investment. Then if it goes up to 40, it goes up. That is what it's supposed to do. If it goes up and down and I keep buying at every level, I keep averaging it.
On that note, it's time to slip into another quick break right here on NSE FinWiz. But stay tuned, it's time for a rapid Q&A session with the audience on the other side. Welcome back. You're still with us on NSE FinWiz in Mindtree, Bangalore. And Harsh, it's time to let the young minds here at Mindtree actually ask their specific financial queries. So if we can have a show of hands and the microphone then to the gentleman with the green shirt.
If you want to more like income tax saving, like one of the option like under section 80 CD, that is the NPS coming, which we have the rebate about 50,000. So what do you think about that NPS?
So there is a special provision carved out for 50,000 rupees, which is allocated towards NPS. What is important is first you look at NPS as a product. Whether it suits your requirements. If it does, then you subscribe to it. You do not subscribe to it only because you're getting tax benefit. The amount that you put into NPS gets accumulated up till your age of 60. You're allowed to withdraw 60% of that corpus as lump sum at that point in time. Up to 40% is tax exempt. So 60% is the upper limit. You choose, you can withdraw 40% out of it. The balance amount gets converted into an immediate annuity. It's a product. It's a separate product. That money goes into a life insurance company, which you choose, and you draw a pension out of it. There are several options available. So it's up to you. If you want a structured product which locks in your money, which doesn't allow you full access, then NPS is a brilliant product. If it fits into your schemes, because the cost is very low, it is a very well managed fund, there's a proper structure. But if you can manage your money on your own, I would rather pay the tax, but make sure that I can invest in a better product. Why do I say that? In an NPS, if you choose a fund E, that is highest allocation towards equity, in that the highest allocation is 50% of your money will go into equities. But if you're investing for 20 or 30 years, why would you restrict your investment into equities to only 50%? You're confusing it with PF. PF gives you a fixed interest every year. It announces an interest. In this, it is functioning similar to a mutual fund. The NAV is going up and down. So there is no fixed assurance in NPS.
All right. So can we have the microphone to the gentleman in the first row in the black and white t-shirt, please?
What would you suggest? Is it good to invest on a PPF or the NPS, 50% on NPS and 50% on the PPF? Or also I have a chances of, I have a thought on putting it in the ELSS. So which one do you think is the best option?
If you can stay invested for 15 years and you're not dependent on this money at all, a higher portion of this should be allocated towards ELSS. I'm not saying put 100%. You could divide your money. You could think of putting about 70% in ELSS and 30% in PPF. You could balance it out. NPS is a different product altogether. It's a recurring commitment that you have. If you're comparing ELSS with a PPF, assuming that you have a 15-year time horizon for both, then the best thing to do is that you can divide this money, but not equally. Equally is a brainless exercise. You don't need to put anything. Let's divide it equally. But since you don't need it, I would say, why don't you take 70% exposure in ELSS and 30% in PPF?
The microphone just behind you, please.
What is the risk factor associated with derivative market when we compare with this equity market and for the retail investor like us?
The difference between trading in cash market and derivatives is 20 times. If you're trading in a cash market, in equity markets, you're putting all your money. If you had a 1 lakh rupees, you're trading with 1 lakh rupees, the exposure that you have is 1 lakh rupees. Because that's the kind of shares that we bought, right? Whereas in F&O, in derivatives market, this 1 lakh becomes a margin money. And your exposure is 20 times more. So your risk is 20 times more.
The mic to the gentleman in white.
The market is going up and down. So when to exit or how long we can hold?
A company may have done an all-time high of 250 rupees. But there is no guarantee that if it's once touched 250, it will always come back. It is dependent on the business. Now what we talk about when we talk about the long-term assets, okay, why equity is the best asset class? It's not relevant to one stock by itself. It's a basket of companies. So when you invest in a basket of 30 to 40 companies put together, 1 or 2 may be this particular company, but you need other companies to work, right? So you diversify. And this is where mutual funds come into picture. When you invest in a particular scheme, they invest in a basket of 30 to 40 companies. So there could be a possibility that they picked up a company which is the same one which you invested in, and that company has gone completely bust. But other 29 companies are going to do well. So the impact on your entire portfolio is minuscule amount. So that is why when you invest, always create a basket. If you can create a basket yourself, great. If not, then give it to a fund house which is already creating a basket for you. And if the business is not good, suppose you had bought it at 150, for example, the price is reached 300. At that point in time, should you buy or sell? So one view would be that I've made double my money, let me sell it. On the contrary, you have to also think, If this company is growing, why should I not buy more shares at 300, right? So you could also think of buying more. Why? Because if you sell at 300, do you have another better opportunity? Do you have another company going up at the same rate? So unless you see and find another company with the same growth potential, you would not want to sell at 300 also.
Well, with that, we're absolutely timed out on this edition of NSE FinWiz. From all of us here at Mindtree, Harshvardhan, thank you so much for joining us on the show. And for all the viewers, thanks for tuning in and keep it with CNBC TV 18.
There was a lot of learning involved, especially as someone who's just entered the workforce and is still like coming to grips with taxation and savings and everything. I was very confused. I think I found somewhere to start now.
Today's session was really great because whatever you want to invest, whenever you have some money to invest, but you will not find where to invest. So today Harshvardhan told us many ways. Equity is the one thing which I learned, and I am going to seriously invest on that.
Focus, ideate, innovate, enable.